Imagine waking up and realizing that one of the most scientifically sophisticated oncology companies ever to list on the NASDAQ, a company built on genome-scale CRISPR screening and high-resolution synthetic lethality mapping, has reached a point where its stock no longer reflects its science at all, but instead orbits around a single question about whether an acquisition will close. Before we go deeper, if you're watching this on Shorts, tap the full-length link below so you can hear the entire story without interruption. And since this episode includes the current trading strategy based on the latest situation, make sure you stay until the end. Imagine seeing a stock that once moved on biomarker stratified trials, now moving on filing schedules, court timelines, and the step-by-step mechanics of a cross-border merger under Quebec law. And the strangest part is that none of this happened because the science failed. It happened because the narrative shifted. If you've ever watched a biotech chart flip its logic overnight, the story of Repair Therapeutics, ticker RPTX, is the kind of story you already understand at a gut level. Repair entered the public markets on June 19, 2020, with one of the most ambitious technological visions in the oncology sector. While standard cancer drug development usually targets overexpressed receptors, activated kinases, or immune checkpoints without needing precise genomic context, Repair built its strategy around synthetic lethality. That means uncovering gene pair dependencies where the loss of one gene forces a tumor cell to rely completely on another, creating an extremely precise therapeutic vulnerability. Their discovery engine, SNIPRX, was a genome-wide CRISPR functional genomics platform designed to reveal exactly those weak points. This positioned Repair as a platform company, not a single asset biotech capable of generating multiple drug candidates. The pipeline that emerged was substantial: camonsertib, or RP3500, an orally bioavailable ATR inhibitor; lunresertib, or RP6306, a PKMYT1 inhibitor; RP3467, a Pol theta ATP ACE inhibitor; RP1664, a PLK4 inhibitor. The collaboration with Roche validated the platform approach. In typical biotech collaborations, big pharma usually remains in place at least through mid-stage development, unless undergoing strategic realignment. So when Roche abruptly terminated the collaboration in February 2024 and returned global rights to camonsertib earlier than expected, the move stood out as unusual. In ordinary biotech operations, early termination is most commonly tied to negative data readouts or clear portfolio conflicts. But that was not the case here. Clinical signals remained promising. That discrepancy left investors concerned about development costs, timeline extension, or changing priorities at Roche. Repair suddenly held total control of a valuable asset, but also total responsibility. The science remained intact, but the business model shifted. Throughout 2024, Repair released encouraging early-phase data from trials like Mythic and Trezor, showing activity in genomically unstable cancers such as platinum-resistant gynecologic tumors. Normally, positive signals like these are used to raise capital or secure additional partnerships. Instead, in August 2024, Repair announced a strategic reprioritization. Pipeline breadth was reduced, spending was tightened, and internal resources were consolidated. That was another anomaly. Under typical conditions, platform biotechs expand when early clinical momentum appears. Repair contracted. This suggested that the company was preparing for major structural change. Then came the pivotal event. On May 1, 2025, Repair outlicensed its entire discovery engine, including SNIPRX, SNIPRX-SURF, and STP2, to DCX Biotherapeutics. In normal biotech strategy, a company almost never parts with its core discovery platform, because that platform feeds the long-term pipeline and underpins valuation. Repair received about $4 million up front, a 10% equity stake in DCX, and milestone eligibility. Roughly 20 discovery employees and part of the Montreal research site transferred with the platform. This was not a tactical licensing deal. It was a full identity shift, the kind of shift that typically precedes an acquisition. By mid-2025, financial data painted a clearer picture. Quarterly collaboration revenue hovered around $12 million. Trailing losses tightened to around $72 million. Cash was being rationed carefully. Repair was behaving not like a growth biotech, but like a company intentionally reshaping itself for merger consideration. In the biotech industry, when a company divests its discovery operations and compresses its structure like this, an acquisition is the usual outcome. That outcome became official on November 14th, 2025, when Repair announced a definitive agreement to be acquired by Xeno Therapeutics. The terms included approximately $1.8 per share in cash and a contingent value right lasting up to 10 years. CVR structures are rare and appear when an acquirer believes the target's assets may produce long-term value that cannot be priced confidently upfront. This indicated that Repair's programs had meaningful optionality but uncertain timelines. Once the deal was announced, RPTX transitioned from a biotech equity into a merger arbitrage instrument. The stock converged toward the $1.8 deal value, stabilizing near $1.65 as markets priced the probability of closing. Technical indicators matched this shift. The price drifted under the 10-day, 20-day, and 50-day moving averages, now near $1.9, $1.85, and $1.75, because the stock no longer generated organic momentum. Yet it remained above the 200-day average, around $1.4, because acquisition news re-anchored valuation. The RSI settled near the mid-range. Bollinger Bands narrowed. The MACD flattened. These were classic signs of an event-driven stock governed by shareholder approval, court review in Quebec, and the acquirer's readiness to close in early 2026. Looking ahead, the short-term trading range is defined by the remaining spread between roughly $1.65 and the $1.8 acquisition price. In the medium term, once the merger closes and the common equity disappears, the CVR becomes the only remaining vehicle for upside. Its value will depend entirely on whether assets like camonsertib, RP3467, or RP664 generate licensing deals or milestone payments. In the long term, the potential payoff depends on whether synthetic lethal strategies ultimately translate into commercial drugs, producing optional payments for CVR holders. Repair Therapeutics began as a frontier biology platform company determined to reshape precision oncology. It evolved into a streamlined clinical asset entity navigating limited capital. Now it stands on the threshold of an acquisition that will end its run as a public company while preserving a decade-long contingent claim on future scientific success. Each shift reshaped its valuation not because the science changed, but because the narrative changed. And in the world of biotech, narrative often becomes destiny. And before we wrap, to all of you who watch, subscribe, like, comment, and share these episodes outside the platform, thank you. Your support means more than you know, and I will keep raising the bar to reward your loyalty with even better content. This was Value Stone.